Hello, my name is Sean Davies, and these are things that are important but incredibly underappreciated. I'm a finance professor at the University of Colorado Boulder. It is move-in week at CU Boulder, so go Buffs. Welcome all to the freshmen and returning students. We hope it's a great academic year. Today, I'm going to talk about money market funds and why they're good for savers and why this is a continued headwind for banks, particularly regional banks, and why we're not out of the woods yet on some of the things that we saw back in March of this year when banks like Silicon Valley collapsed. So I'm going to start with sharing the screen, and I'm going to highlight a tweet that came out from Wall Street Journal reporter Gunjan Banjiri. You should all follow her. She produces a great amount of content, excellent, timely stuff. But she highlighted this morning that money market yields have soared to 5.15%. That's the highest level in about 24 years. So, by historical standards, very high interest rates on money market accounts. Now, you might be wondering why this is interesting. Well, first, for savers, people that have, say, some liquidity in their checking account or savings account, like a rainy day fund, these money market accounts are a great investment. Okay, you can make 5.15% by putting your liquidity in a money market fund. Now, if you compare that to what banks offer, say, on checking accounts, which is usually zero, or what you can get in a savings account, which is usually less than 0.5%, this presents the opportunity to make a lot of money, or at least a lot more than your next best alternative. Now, what is a money market fund? Well, a money market fund holds short-term debt, things that mature in just a couple weeks or even shorter. And these are very high credit worthy names in securities. So there's very little risk associated with them. And to give you an idea of why the yields are so high, we can sort of tether it to the 1 month treasury, which matures in 1 month. And that is yielding almost 5.4% currently. And that is a very safe instrument to invest in. So that gives you an idea of what we're sort of tethering the money market rates to. So to give you an idea of how much more money you could be making, let's jump over to a spreadsheet. So if we jump over to a spreadsheet and we just look at, suppose you had $10,000 in liquidity that you were holding in the bank. Now, this might be liquidity you're holding as a rainy day fund, just in case those unexpected life circumstances come up. Well, if you held that in your savings account, right now, on average, you'd be making about 45 basis points or 0.45%. And what that implies then is that $10,000 over the next year would make about $45 in interest. And you could maybe go to dinner with that, probably just by yourself. You're not going to be taking your family out to dinner, except maybe to fast food for $45. Now, if you compare that to the money market funds, which again are extremely safe vehicles, and you'd be making 5.15%, well, over the year, you'd make $515. Okay, that's enough to typically make a car payment. So one of your car payments for the year would essentially be paid for just by the interest paid on these money market funds. So the fact that money market fund rates are so high right now is really good for savers. It's a really nice thing. That said, this is a tremendous headwind for banks. And to understand why this is a headwind for banks, we need to understand what a balance sheet is. So let's go over to some slides. If we go over to some slides and think about what a balance sheet is, a balance sheet is a snapshot of a firm or a bank's financial position. And balance sheets go back hundreds of years ago to trade in the Mediterranean when merchants would settle their accounts using a tea table or using this double entry system. And so what this balance sheet does is it tells us everything that a firm or a bank or a household, any entity holds, both in terms of the assets, what it owns versus what it owes, things like debt. Okay, and so there's this really nice balance sheet identity that assets, which appear on the left hand of the balance sheet, the value of those assets must always equal the sum of the liabilities plus something called equity or shareholders' equity. And so the assets are going to appear on the left-hand side. These are things like cash, machinery, property, all sorts of things. Okay, those appear on the left-hand side of the balance sheet. And on the right-hand side are liabilities. Okay, and the way to think about these liabilities and assets are the following. Assets are what the company owns or the bank owns. Things like cash, or maybe the bank has made loans to individuals and those individuals are going to pay them principal and interest. Okay, that's an asset. It generates cash flows. And these assets are going to be ordered according to liquidity. So guess what is at the very top? Cash, because cash is most liquid. And then it'll be things like short-term treasuries that are super liquid, then maybe down into loans that we've granted to households and small companies that you can't call back easily or at all. Now, liabilities are what the company owes. Okay, and these are also going to be ordered according to liquidity. So, in the context of a bank, if you deposit your money at the bank owes you that money back. And so, if you look at a bank's balance sheet, its deposits are the very top liability, the most senior liability, because it's what it owes its depositors. Then the bank might have some things like some borrowing. Maybe they raised capital through offering debt to the markets. And this is going to be less liquid or less senior than deposits. And then finally, when we get to the very bottom of the liability structure, there's something called equity. And it's just going to be the difference between the assets minus the liabilities. Whatever that residual is the equity. And the way of thinking about equity is it's what the company owes its owners. Okay, so sometimes it's referred to as shareholder equity, but importantly, the balance sheet must always balance. The asset side of the balance sheet must equal liabilities plus shareholders' equity. So to bring this home, let's just think about a mortgage. If you own a house, the house is the asset. Okay, so that's going to appear on the left-hand side of the balance sheet, the home value. And if you bought that house using financing via mortgage, that mortgage you owe, okay, is debt, and it's going to appear as a liability. And the difference then between the value of the house and what you owe your bank in terms of your mortgage, that residual is what we oftentimes refer to as homeowner's equity. So in this example, the house is worth 500,000, the mortgage is 325,000, and so whoever owns that house has $175,000 in equity. So if you understand houses and mortgages, you understand balance sheets. And so let's just go to a hypothetical balance sheet for a bank. So we're going to step back into Excel and we're just going to look at this balance sheet for this hypothetical bank. What you'll notice is there's some cash at the bank. That's just to meet the short-term liquidity needs of depositors that show up to take withdrawals. Now, banks don't hold your money in a piggy bank. Okay, instead, what they do is they take your money and they invest it in the form of loans. They make loans to small businesses, to households, things like that. And they might also, if there's not enough people borrowing money to make loans to, they might invest it in very safe securities, things like treasuries. And so in this example, some of these deposits that people have paid is being held in cash, like in the vault of the bank. Then there's some investments in securities. And then down here, we see that there's some loans. About $65 million in loans have gone out. These are small business loans, home mortgage loans, auto loans, etc. And then there might be some other long-term assets, like maybe the actual buildings that the bank is in if they own them. And so what we see down here is that the total assets are about $85 million. Let's go over to the liability side of the balance sheet. So as we go over to the liability side of the balance sheet, we see deposits. This is what money people have put into the bank. So let's just assume these are savings accounts. So people have put $81 million into the bank. In addition, okay, the bank has issued some debt on its own, raised capital by selling bonds, borrowing money, and they borrowed $3 million. In the residual, okay, so that the balance sheet balances, is 493,000. Okay, so that's what would determine the equity value of the firm. The shareholders' equity is 493,000. And down here, I'm just going to show the change in equity as we think about investors or depositors, I should say, taking money out of the bank. So suppose that some people see that the money market accounts are paying a lot higher rates, okay, 5% more almost. And they say, I'm almost making nothing on my savings account at the bank. So suppose they withdraw $300,000 and put it into money market accounts. Well, what you see is that cash went down because those deposits had to be satisfied. That said, the balance sheet is still healthy. There's still equity in the firm, plenty of cash on hand to meet deposits, not a problem. But suppose that enough depositors get savvy and they say, you know what? I am not making that much at the bank. I'd be much better off investing in a money market account. And let's just put in $20 million. So $20 million is withdrawn from the bank. Now, what you notice is that cash is negative. And we know you can't have a negative cash balance like this. And so, presumably, okay, the bank would have to sell these securities. And let's just assume that they are able to sell these securities at that 18,410,000 to satisfy all these deposits. What you see is that they still have a deficit of $933,000. Well, they have to cover that somehow. And so maybe they have some long term assets. Maybe these are long term treasuries. Maybe these are buildings. And suppose they go to liquidate them and they're not able, because it's a fire sale, to get the 1.5 million. Or sorry, to get 933,000. They have to sell much more than that because of the fire sale. So let's just knock that down to say zero. What you see is that the change in the equity value, and I should zero out cash as well because cash has been entirely burned through to satisfy those deposits. What you see is that the balance sheet does not balance. The liability side of the balance sheet is bigger than the assets. In other words, the bank owes both depositors and creditors more than the assets it holds. And the wedge here is $567,000. So if we compare that over here to the equity value, there's not enough equity in the firm. It doesn't have enough capitalization. Okay, so this bank is insolvent. Moreover, we're having a lot of headwinds in commercial real estate. Okay, if you walk through the streets of San Francisco or Chicago or any major metropolitan city recently, you probably see a lot of vacancies. Part of this is an artifact of COVID and people working more from home, but that's not good for commercial real estate, where the people that have borrowed money to build buildings and offices and residences downtown, those things are laying vacant. And so some of those loans that this bank made probably are going to be delinquent and maybe defaulted on. And so when we think about the loans over here, the fair value of them is 64 million. Maybe it's not that high given commercial real estate. In fact, there was an article today, if we just go back over to our web browser, that car prices, okay, there's an article in the Wall Street Journal today that there's surging loan delinquencies on auto loans as well. Okay, so if we go back to our balance sheet and just take a moment to look at it, this $64 million or approximately 65, the fair value of that might not be that high because people are going to default on those loans. So let's just knock that down to, let's just be conservative and say 62 million. Okay, what you see is that the equity is even more in the hole. And so there's these headwinds for banks, particularly regional banks, where you've got money leaving the bank because deposit rates are so low relative to money market accounts. And the double whammy is that the loans that the bank has made, those aren't as good as they thought they were 2 or 3 years ago. And so that's why we're not out of the woods yet with the regional bank crisis back in March. There is still a lot of game time left in this game. And so while we look at money market accounts and we say, hey, this is good for savers, they're making more than they could make in bank deposits, this could be a very problematic thing for banks going forward. So again, these are things that are important, but incredibly underappreciated. I hope you enjoyed it and go Buffs.